Ever open up a financial chart for the first time and just stare? Whether you're looking at stocks, forex, or crypto, it can honestly look like an absolute mess of chaotic lines and flashing colors. But welcome to this explainer, because I'm here to tell you it is not chaos. What you're actually looking at is a real-time story of a brutal, constant tug-of-war between the bulls and the bears. And today, we're going to learn exactly how to read that story.
So think about that for a second. What if market chaos is actually a highly predictable story? Because what looks like jagged random noise to a total novice is actually a hidden, incredibly readable language for finance pros. Every single tick, every shape, and every pattern holds a massive clue about who is winning the battle for market control. And once you know how to translate this visual language, you can start making real sense of market movements.
All right, here's our roadmap for today. First, we'll cover the candlestick alphabet. Second, momentum and market indecision. Third, powerful reversal patterns. Fourth, reliable continuation patterns. And finally, a risk management strategy to tie it all together.
Okay, let's dive right into part 1, the candlestick alphabet.
Let's start at the microscopic level. Every single candlestick you see on a chart is built from 4 specific data points. We call this OHLC: open, high, low, and close. Over whatever time frame you choose, whether it's a single frantic minute or an entire day of trading, these points tell a micro story of where the money is flowing. That thick, wide part of the candle, that's what we call the real body, and it marks the difference between the opening price and the closing price. Those thin lines sticking out from the top and bottom are the wicks, or shadows, and these show us the absolute price extremes, literally the highest and lowest points reached during that specific battle.
And this brilliantly illustrates the absolute most basic rule of the game. A green or bullish candle means the buyers won that session. The price opened low, and they pushed it up to close high. On the flip side, a red or bearish candle means the sellers took control. The price opened high and was aggressively driven down to close lower. It's the exact same dynamic, just moving in completely opposite directions.
Moving right along to part 2, momentum and market indecision.
Now, before we look at specific chart setups, I want you to use this classification matrix as sort of a mental filing cabinet. We're going to use this to categorize every single pattern we're about to decipher. Every pattern has a complexity. It's either a simple one-candle setup or a complex pattern made of 2 or more candles. It has a direction, meaning it pushes bullishly, bearishly, or just stays neutral. And lastly, it has a type. It's either a reversal pattern, trying to turn the market completely around, or a continuation pattern, pushing the existing trend even further.
So getting a read on this tug-of-war is pretty straightforward. Large bodies show decisive momentum. In fact, to truly call something a momentum candle, that real body should be at least 2 times the size of the previous candles. That is a clear, undeniable signal of strength. On the other hand, small bodies with super long wicks prove that neither the bulls nor the bears are in full control. The ultimate sign of this indecision is what's called a doji candle. This is where the opening and closing prices are at the exact same level, leaving virtually no real body at all. It's practically a perfect tie.
That brings us to part 3, powerful reversal patterns.
Let's move to our first set of full visual sentences. Our first reversal pattern is the bullish engulfing setup. Now, context is absolutely critical here. This setup must happen at the bottom of a downtrend. First, you're going to see a small red candle, which kind of hints that the sellers might be running out of steam. Then, out of nowhere, a large green candle appears. It opens lower, but surges to close way above the previous red body. The buyers have entirely overwhelmed the sellers in a single powerful move. They've effectively engulfed the previous day's action, signaling a major trend reversal to the upside.
Now, I absolutely love this next one. The hammer pattern is amazing because it perfectly visualizes a failed ambush by the bears. This is a simple one-candle reversal pattern that, again, must occur in a downtrend. During the trading session, sellers aggressively drive the price down, which creates this massive lower wick. But before the candle actually closes, buyers completely reject those lower prices, forcing the price all the way back up to create a small real body near the top. That massive lower wick, which by the way has to be at least twice the size of the body, serves as visual proof of the buyers fiercely defending their territory.
All right, let's shift gears to part 4, reliable continuation patterns.
Reversals are definitely flashy, but continuation patterns are basically brief trend pauses before the market resumes its original direction. Let's look at a highly reliable structure known as the bull flag.
First, a strong uptrend creates the flagpole. Then the market just needs a quick breather, so it consolidates, printing 3 or more small candles that drift slightly downward against the trend. This forms the flag. Finally, the buyers step right back in with strong momentum. A large green candle bursts out, closing above the opening of that last pullback candle. Boom! This confirms the pause is over and that original uptrend is ready to soar again.
And finally, Part 5, arguably the most important section of all, risk management strategy.
Because, let's be real, reading the history of the charts is totally useless if you can't predict the future safely. We need strict execution mechanics to protect our capital. The general rule of thumb is to enter a trade exactly at the close of the candle that confirms your pattern. But crucially, and I cannot stress this enough, you must set a stop-loss order. If it's a bullish trade, this goes just below the pattern's lowest point. And always leave a little bit of wiggle room so a tiny price fluctuation doesn't just knock you out prematurely. Finally, adjust your stop-loss based on previous support or resistance levels on the chart. Your stop-loss is your absolute safety net because no pattern works 100% of the time.
2 to 1. This number right here represents the golden risk-to-reward ratio. When you enter a trade based on these candlestick patterns, you should be aiming for a 2 to 1 ratio. Mathematically, this means you are aiming to make $2 in profit for every $1 you put on the line. By measuring your stop-loss distance and then doubling it for your profit target, you are cementing the fact that successful technical trading isn't just gambling, it's highly calculated probability.
And honestly, this quote might be the most powerful takeaway from our source material today. Losing trades doesn't have to be a bad thing, it's simply a part of the game. If you rigidly stick to your execution mechanics and you maintain that 2 to 1 risk-to-reward ratio, the math works in your favor. You can actually lose more trades than you win and still come out highly profitable at the end of the month. The charts provide the edge, but your discipline provides the profit. And trust me, leaving your ego at the door is definitely the hardest part.
So we've covered the alphabet, the momentum, the reversals, the continuations, and that all-important risk management strategy. The chart is no longer just chaotic lines to you, it's a living, breathing story of buyers and sellers. So I want to leave you with this thought. Now that you can read this hidden financial language, how will you translate your next investment opportunity? Are you going to let the market dictate the terms, or will you use these patterns to define your own edge? Thanks so much for joining me for this explainer, and happy charting.